We live in a world awash in currency. We use it every day, but rarely do we stop to think about where it came from. How did we get from trading chickens to tapping credit cards? It's a fascinating journey. The evolution of money is a testament to human ingenuity. It reflects our constant desire for efficient exchange and economic growth. Money is simply a medium of exchange. It represents value. Money has allowed for complex economies to develop. The earliest forms of trade were rudimentary. Imagine a time when people simply exchanged goods and services directly. This was the barter system. It formed the foundation of early economies. As societies grew more complex, so too did their methods of exchange. We invented new forms of money to meet our changing needs. These innovations paved the way for the modern financial systems we see today. In the beginning, there was barter. This system relied on the direct exchange of goods and services. If you had wheat and needed salt, you had to find someone willing to trade. Barter worked well in small communities with limited goods. However, as societies expanded, the barter system revealed its flaws. It suffered from a fundamental problem, the double coincidence of wants. The double coincidence of wants occurs when both parties involved in a trade desire what the other has to offer. Finding this perfect match was inefficient and time-consuming. Imagine trying to find someone who not only wants what you have, but also has what you need. The limitations of barter were evident. It hindered economic growth and prosperity. Societies needed a more practical and efficient system of exchange. This need led to the emergence of money. The first step away from barter was the adoption of commodity money. This involved using a valuable commodity for exchange. Early examples include cattle, salt, and even shells. These commodities were durable, divisible, and widely accepted. As trade routes expanded, societies shifted towards representative money. This form used tokens or certificates that represented a fixed amount of a commodity. This commodity was often a precious metal like gold or silver. The introduction of paper money marked a significant shift. This fiat money had no intrinsic value. Its worth came from government decree. Governments declared it legal tender, guaranteeing its acceptance for payments. Section 4. Understanding money supply and its measures. Money supply refers to the total amount of money in circulation within an economy. It's a key factor that influences inflation, interest rates, and overall economic activity. Too much money can lead to inflation, while too little can stifle growth. Economists use various measures to track the money supply. These measures categorize different types of money based on their liquidity, or how quickly they can be converted into cash, M0. This is the most liquid form of money. It includes physical currency and central bank reserves, M1. This measure encompasses M0 plus demand deposits like checking accounts, M2. This category includes M1 and adds savings deposits, money market securities, and other less liquid assets, M3. This broadest measure includes M2 and adds large time deposits, institutional money market funds, and other financial instruments. Understanding these measures is crucial for policymakers. It allows them to implement effective monetary policies to stabilize the economy. Section 5. Central banks, guardians of the monetary system. Central banks are the guardians of a nation's monetary system. They play a pivotal role in maintaining economic stability. They act as the government's bank and the banker's bank. One of their primary functions is to control the money supply. They achieve this through various tools, including setting interest rates. By adjusting interest rates, central banks can influence borrowing costs and investment levels, directly affecting the money supply. Open market operations. Central banks can buy or sell government securities in the open market. Buying securities injects money into the economy, while selling them withdraws money. Reserve requirements. Central banks can set reserve requirements for commercial banks. These requirements determine the amount of money banks must hold in reserve, influencing their lending capacity. Central banks also play a crucial role in regulating the financial system. They supervise commercial banks and ensure the stability of financial markets. Section 6 are commercial banks and money creation. Commercial banks are the heart of the financial system. They act as intermediaries between savers and borrowers. They play a crucial role in the economy by facilitating the flow of funds. One of the key functions of commercial banks is accepting deposits. When you deposit money into your bank account, you are essentially lending that money to the bank. Banks then use these deposits to make loans to businesses and individuals. This process is known as fractional reserve banking. They lend out a portion of their deposits while holding the rest in reserve. Fractional reserve banking leads to money creation. When a bank makes a loan, it creates new money in the economy. This new money is created through the magical process of credit. By managing their lending activities and reserve requirements, commercial banks play a significant role in influencing the money supply.